Welcome to Think Smart with TMFG. I'm Mike Connon. I'm here with financial advisor John Iaconetti with the McClelland Financial Group of Assante Capital Management. So, John, today I was going to start to talk about corporations.
Yep.
And I guess the big question is, when do you want to become a corporation? It's a big question we have. At what level of income do you think I should consider incorporation? Because there's expenses that go within a corporation. So you don't want to be making $50,000, $60,000 a year and have to pay all the amount of money that's going to go to a accountants and the corporate setup.
Yep.
And then on the other hand, you don't want to be making $2 million a year and not have a corporation.
That's exactly
so
it.
somewhere between those numbers is a point where you're supposed to move from being just, I guess, a sole proprietorship over to a corporation.
Yeah.
I'd ask you when that number is, but it's a very difficult number to come
Very
up
tough.
with. It depends on the expectations on where the corporation is growing. You know, a lot of people say once you get to $150,000, $200,000 a year of income, it may be time to start considering that strategy. But it depends on the future and where it's going to go. So it's hard to come up with one number that just works for that.
Yeah, exactly. It's and today's focus is going to be touching on all those key points of, you know, the top 5 things that you should be considering as you start to progress and as you start to become a bit more successful, maybe in your sole proprietorship like you have, or even your corporation itself. You start earning more, you know. And what are those things that you should key in on that should become top priority? And maybe we kick things off with, the first thing to focus on, and that's determining a tax-efficient compensation structure.
Yeah, you have a choice when you have a company. There's different ways to draw money out, and they all have in different financial gains and financial losses.
Yep.
A corporation is a good structure to hold money in if you want to hold money.
Yep.
You know, a lot of times what we say is, if you're going to spend every dime you make, corporate structure doesn't really help you much.
Yeah.
So if you plan on bringing in, let's say, $200,000 of income, and you're spending all that income, the corporate structure is just a nuisance around it. So when you have that corporation set up, you have to decide whether you're going to take salary or dividends from it. And of course, salary is nice because salary is a deduction for the corporation.
Yep.
So it helps reduce the income tax inside the corporation. But the corporate tax is a lot lower than your personal tax rate at many times.
Yes.
And if you take dividends out of the corporation, it's tax preferred to take out. It's treated a lot better from a tax point of view. But the problem with dividends are not a deduction for the corporation. So you're still going to have to pay tax inside the corporation. The government has made it so, from a tax point of view, they should be relatively neutral.
Yeah.
And that's how they've set everything up. But, you know, it depends on your own circumstances what one's going to work the best for you.
Yeah, no, it's all very good points. And for some of those that maybe have, you know, a bigger practice, you also have potential for compensating for the spouse. Now, this has become a bit of a gray area because obviously there has to be reasonable expectation to have those payments made, thanks to the TOSI rules. So we do have to make sure that you're staying on top of that. But that could become an option where if your spouse is contributing within the corporation, could become a great way to pay a salary or dividend out to them.
It's funny, as I was getting ready for this podcast, I realized your most important thing is a good accountant.
Oh, yeah.
You know, this stuff gets very complicated. We're just touching the surface on this. And accountants understand this intrinsically. It's part of their DNA.
Yeah.
And they can see everything going on in the corporation, where to go. So remember, for advice, you always need an accountant. You can't really do this stuff yourself.
Absolutely. But maybe we'll bring us over to the second point that people should be prioritizing. And it's a way to protect yourself and the business. So you could do that either through the corporate structure itself, but also even through insurance as well. Obviously, as you become more and more successful, you're going to need to protect yourself and your ability to earn that income.
Well, let's start with a corporation to begin with. One of the main reasons people do a corporation is a corporation is a separate legal entity than yourself, which means that if something went and someone sued your corporation, they're not suing you. They're suing your corporation.
Yep.
You know, when you go down the street, you see all these companies having bankruptcy sales. That doesn't mean they're taking all those people's houses away, right? It's they're going bankrupt from a corporate level, but it's not happening on a personal level. So a corporation is a separate entity. And what people do too is inside a corporation, many times people have what they call the opco and the holdco.
Yep.
And what they do, they create 2 corporations because, again, they're 2 separate entities. And the idea behind that, the holdco is going to be a holding company, and that's going to generally hold the, let's say, assets of the corporation, because you want to keep those safe. And you want to invest them and keep them safe, keep them separate way from the day-to-day business. The operating company is going to be the day-to-day business. But the operating company, because of whatever it's doing, depending on what business it's in, it has the risk of being sued or liability coming against it.
Yeah.
So you don't want someone to go and sue your company and then all of a sudden have it come back and take all your assets away. So you create two separate companies that are separate entities, and that protects the holding company where you're keeping money from lawsuits that are going on the business. And we hope to never have lawsuits, but depending on what type of business you have,
Possible.
it may be a reality.
Yeah, exactly. And that's a perfect breakdown of, where having that extra company just provides that extra layer of security. You don't want your, a lot of businesses maybe retain earnings and keep a lot of money and a lot of cash within the business. But if you're doing that within your operating company, like you said, a lot of that is subject to risk. And speaking of risk, the other side of it, it's, we talked about litigation and issues like that, but it could also just be health issues in regards to the key people that operate the business. So that's another thing to, protect yourself. Could be in the form of key person insurance, life insurance, disability, things like that. Especially for a one-man shop or something like that. If you're not able to generate the income, then your corporation loses a lot of its value. You need to be able to protect that.
So speaking of value inside a corporation, so what happens if you have a company that's doing really well and you're actually making more money than you need to live on? What are some options you have?
Yeah. Well, just like personally, if you're starting to accumulate tons of wealth and you have it in a checking account, it's not doing you too good. You got to start thinking about long-term and thinking about investing.
Now, inside a corporation, there's lots of advantages to having investment accounts inside a corporation. So that can be, from a tax point of view, it can be a good system to keep your money in. Investment income is taxed at a much higher rate than active income in a business. So there's active income and there's investment income. Investment income is basically at the top tax rate anyway. So the idea of should it be in a business or be personal, it's identical almost, right? But there's some advantages to how you can get money out of the corporation through these things. And one is called a CDA account. So it's a capital dividend account. Give us a bit of a detail what that is.
Yeah, so think of it this way. With a capital dividend account, if you're earning capital gains personally, half of that would be taxable to you, half of that is not taxable. Essentially with the capital dividend account, it's not an actual account. It's essentially more like a ledger item that your accountant would keep track of. But as you're investing and your money continues to grow, a certain amount of that you will be able to access and take out of your corporation tax-free. So to your point, it becomes a great way to be able to access some of the funds that are held within your corp.
And these CDA accounts, much as we talked about with a capital gain, if you get a capital gain in a company, let's say $100,000 of a capital gain, $50,000 would go as income to the corporation. The other $50,000 would be added to the CDA account. And this CDA account can be taken out tax-free from the company in the future. Also insurance, so things that are tax-free like the other half. If you have insurance proceeds, if something happens of a life insurance policy, those proceeds would go to the capital dividend account and allowed to be taken out tax-free. So again, gives you some advantages in there.
Yeah, absolutely. But the one thing that to consider throughout all this is obviously if it's an operating company, the government tends to put a little bit of limitation on the passive income that you can earn. And the way they do that is through the small business deduction. So up to $500,000 revenue is able to be at a tax preferred rate, but that'll actually get clawed back the more passive income that you begin to incur.
Yeah, I think that's $50,000, is it?
500,000 is a small business deduction, but then above 50,000
gotcha.
of passive, that's when they'll start to claw back your small business deduction.
Yeah, so once that 50,000 in passive income comes in, you start to lose that, and it becomes a pretty big hit to companies.
Absolutely. And that small business deduction can be fully clawed back if your passive income goes above 150,000. So it's something to keep in mind. If that's the case, then maybe that's where dividending some of the money out, and it's maybe better suited not to be within the corporation. But like you said, this is why people hire accountants to keep a good eye on all that.
And again, you got to watch what type of investments you keep in the account.
Absolutely.
Like if you look at if you're getting dividends, they're going to be at a much less rate, and you can offset fees against it. So you can actually, it gives you some room in there, to be honest, to make that type of income. Because remember, even if an account makes 8% a year, generally not distribute 8%. It might distribute 1.5% to 2%. There'll be costs in that. So the distributions aren't as large as you think. So you can actually hold a reasonable size account before you start to deal with these issues.
Gotcha. But I guess that brings us over to the fourth point. One of the things that most successful businesses do, or you should be doing, is start to optimize your deductions that are available within the company, and also keep good records. That's, I think, very underrated thing that a lot of companies, maybe if you're really busy and stuck in the nitty gritty of it, it's a really great thing to have to start to keep that data and have something to fall back on just in case for some of your records.
None of us like bookkeeping, but it's an essential part to any business. And having a good bookkeeper who keeps all this under control. Remember, the great thing about companies is there are things you can actually write off inside of them.
Oh, yeah.
So you take a look at all your expenses and decide which ones are actually company related, and then you keep those inside the company. And as long as you can do that legitimately, you're in a situation where you're reducing the income on the corporate side of things. And again, there's a lot of important expenses that can be put into that company.
Yeah, absolutely. So, sometimes the conversation comes up and you think you're keeping all these records just strictly for compliance purposes or, to check a box. But really, even for like our business, for example, to be able to look back into your history and see, where you've come from in the last 5 years, really see growth and really, as us as data people, be able to project out where we're headed. Keeping those records actually provide even extra intrinsic value besides, what you have to do on an annual basis. So, but I guess that brings us into our last point and starting to think about, if you are that successful business and you have been really earning more and more year over year, you're probably going to start wanting to think about long-term corporate wealth as well as potential exit planning. At some point, this is going to come to an end. You may want to retire. What's the best way to go about that?
Well, there's many different ways. Sometimes there's the people that just close down businesses. Doctors generally have businesses set up, but unfortunately, when a doctor retires, there's so many doctors that want to put a shingle on the door. There's really no exit plan for a doctor. They just go and say, okay, I'm done working now.
Yeah.
For other people, they have family involved in businesses. There's many family businesses, and they want to structure a way for that family to continue to run the business and be in control of it. And there's many things you can do with estate freezes and all sorts of things like this to make it a much more tax-efficient way to transfer that company on to the next generation in there. And the other thing is selling businesses.
Yep.
And this is where you got to look at how much your business is worth. Have a evaluation done on it. There's business evaluation is a whole big piece of the accountant industry.
Absolutely.
To find out what that is. Because if you have regular cash flow, people are willing to pay for that. So some people don't even realize the value that's actually inside their business. And to find out how you're going to do that, how to set up the business for that sale. The one thing I always tell people, which is sort of counterintuitive, less important you are to your business, the more your business is worth.
Yeah.
And what I mean, if your whole business is just you and you're not there anymore, your business may not be worth that much.
Exactly.
If your business is a continuing entity and it runs itself, it's worth a lot more for other people. So when you start to think, okay, I'm going to get ready for retirement, what you better start thinking is, how am I going to make this an attractive business for someone else to buy? And that goes into place, 5 to 10 years before that actual sale happens.
Yeah, absolutely. I mean, just from our experience of dealing with some of our clients, you start to realize, a lot of people have a very tough distinction of being able to remove themselves from the business and have it become that self-providing entity because, in a lot of cases, it was their baby. It's something that they put a lot of sweat equity into. But to your point, if it's going to be sustainable, it's going to be sellable, you're not going to be there forever.
For people out there, we're Canadian business owners ourselves. And this is one thing we love. So we love working with business owners who have these situations because it's exciting and we have a general interest in it because that's become part of our life too. So it's good to sit down and deal with someone who's in, a similar situation and really takes a look not only for your clients, but when you look at something on a day-to-day basis, even in your own situation, you get to know it quite a bit better.
Absolutely. Absolutely.
Well, that brings us to the end of another episode of Think Smart with TMFG. Thank you very much for listening.